if you keep doing just what you're doing now, just what you did in 2025 and 2024, 2023, and so on, if you keep doing that, will you ever get in the financial position that you want to be in? Hello and welcome to the Total Wealth Academy podcast. This is our video podcast. We also have our radio show podcast. You can check that out at totalwealthacademy.com. Please subscribe to one or both. We are here together, as always, working hard to improve our financial IQ, our financial literacy. The reason is high school and college don't teach us anything about how to build wealth. They teach us how to get a job, and that's about it. And the problem is a job generally doesn't lead to wealth. It's the side hustle. It's what you're doing with your money that leads to wealth, and you've got to understand that. You can't depend on a job as your sole source of income. Warren Buffett has been saying this for 60 years. He's always stated, never rely on a sole source of income. Always invest to create a second source. So you've got to understand, is Warren Buffett talking about stocks, mutual funds, gold, silver, or crypto? No. The reason is they don't produce cash flow. They don't produce income. He's talking about buying income-producing assets like businesses and primarily real estate. Why do I say primarily real estate? Because 9 out of 10 millionaires in the United States used real estate to become so. So what we're going to do first is we're going to talk about a series of 3 questions that you need to ask yourself now that 2025 is over. And the 3 questions are as follows. The first one is, you want to ask yourself, 2025 is over. Another year has passed. Are you in a better financial position today than you were a year ago? Are you in a better financial position today than you were a year ago? And for most people, the answer is no. I think that the average American took on $6,000 more debt in 2025. So they're actually in a worse financial position than they were a year ago. Now, some of you may say, oh, wow, I'm fine. I'm in the same financial position that I was a year ago. That's actually worse. Why? Because a year of your earning ability is gone. Another year of your earning ability, it's gone. Poof. Can't get it back. So if you're in the same financial position that you were a year ago, you're actually in a worse financial position. The second question to ask is, if you keep doing what you're doing, will you ever get in the financial position that you want to be in? If you keep doing just what you're doing now, just what you did in 2025 and 2024, 2023, and so on, if you keep doing that, will you ever get in the financial position that you want to be in? And again, for most people, the answer is no. Most people are in jobs or endeavors that they know can never, ever take them where they want to be financially, but they keep doing it year after year after year, decade after decade. Why? Because they just don't know any better. They don't know any other way to make money except trade time for money. Get a job, get your paycheck. That's how you make money. That's not how you make money. That's how you make a living. If you want to make yourself wealthy, you've got to do something more. And then the third question is that question. What are you going to do differently in 2026 so that at the end of 2026 you can say, yes, I am in a better financial position than I was at the beginning of 2026. What are you going to do differently? Because you've got to do something differently. You can't continue to do the same thing over and over again and expect a different result. That's a form of insanity. So those are the 3 questions. 1, are you in a better financial position than you were a year ago? 2, if you keep doing what you're doing, will you ever get in a better financial position? And 3, what are you going to do differently in 2026 to ensure that you can say you're in a better financial position at the end of the year? And that leads me to a secret. It's the secret that the wealthy use that the poor and middle class don't. Now, I want to be very careful. I hate the word secret. because there are no secrets. There are no new techniques. This stuff, you see people on podcasts, I've got a secret, I've got some new technique. Wrong. There are no secrets and there are no new techniques. The same principles that Benjamin Franklin used to build wealth, in the 1700s, work just as effectively today as they did back then. But the secret I'm talking about is income-producing assets. Income-producing assets. That's what the wealthy buy that the poor and middle class miss out on. And that's why they are able to retire. They are able to build wealth. They are able to build the life that they want because they buy income-producing assets, not stocks, mutual funds, gold, silver, or crypto. They're buying businesses and primarily real estate. So what you've got to do in 2026 is position yourself to start buying income-producing assets. And yes, it's harder than buying stocks and mutual funds, gold, silver, crypto, but your rate of return is astronomically higher. I'm going to go over the 4 ways that every dollar you have in a piece of real estate makes you money. And you're going to see that the first year that you own a little single-family house, you're probably going to make a 200% rate of return. Now, I want you to think about your stock market investments, your gold, your silver. Are you making a 200% rate of return there? The answer is no. You've got to understand, income-producing assets make money multiple ways, whereas stocks, mutual funds, they only make money one way. That's if they go up in value. That's the only way they make money. With income-producing assets, you've got cash flow, equity buildup, appreciation, and equity capture. Equity capture is the big one. Equity capture is what makes you wealthy. The cash flow is what makes you financially independent. The equity capture is what makes you wealthy. But we'll talk about all that in just a minute. But the bottom line is, in 2026, you want to start buying income-producing assets. And you can do this with your IRA. You can do it with your 401k without tax or penalty. Very few people know this. Very few people. But you can use your IRA or 401k to buy real estate without tax or penalty if you know what you're doing. We teach people how to do that at Total Wealth. So let's go into the 4 ways that every dollar you put into a piece of real estate makes you money. The first, and for me the most important way, is the cash flow. I'll take a little deal I did here in Houston off of a street called West Green. I picked up a $220,000 house for about $110,000. Why so cheap? Because it was a disaster. It needed $45,000 worth of work. $45,000 worth of work. I had about $10,000 in closing and holding costs. So my all-in cost was about right around $170, we'll say. That deal was $20,000 down, $20,000 total out of pocket. Now, some of you are going, wait a minute, if I went to a bank, that would have been $67,000 down. I didn't go to a bank. I went to a mortgage company that found me a private lender that gave me the money, and that's how I was able to get into that deal for just $20,000 down. This is something you need to educate yourself on. I will do a podcast on it. It's called a hard money loan or bridge loan. So I get this bridge loan, and I get into the deal, literally just $20,000 out of pocket. Well, the first way that this deal made me money is that it profited about $500 a month in cash flow. My rent was around $2,100 a month. My mortgage principal, interest, taxes, insurance, maintenance, and vacancy was down around, $1,600, $1,700 a month. Bottom line, I was making about $500 a month. Well, $500 a month times 12 months, that's going to be $6,000. That's about a 30% rate of return on that $20,000 that I invested. Now, question, what are you making on your money? Your money that's in the stock market, in mutual funds, gold, silver, crypto. Are you making a 30% rate of return on your money? I know the answer. It's no. get some real estate in your portfolio. But that's just the first way that it makes you money. The second way is equity buildup. Equity buildup. Every month that my renter paid their rent to me, I paid a mortgage and I reduced what I owed on the property every month. Now, it's not a lot. It might only be 2.5% per year at the beginning. It gets bigger and bigger as you get towards the end of the mortgage. But at the beginning, when you're first holding these properties, it's not a lot. It might be $9,000. But $9,000 divided by the $20,000 you have in it, that's another 45% rate of return. 45% rate of return. The third way that real estate makes you money is appreciation. That thing's going to go up in value, about 3% a year. Real estate doubles in value every 20 years, but that translates to just about 3% a year. But bottom line, 3% of 200,000 is 6,000 divided by the 20,000 you've got in it. That's another 30% rate of return. You're up over 100% rate of return just on these three alone. But let's look at the big one. And this is the one that builds your wealth. It's a thing called equity capture. In this particular case, I picked up a $220,000 house for $170,000. Let's just say it's worth $200,000. I picked up $30,000 equity the instant I bought that property. The instant I bought that property, my net worth went up $30,000. That's equity capture. But if you look at your rate of return on that, you divide $30,000 by the $20,000 you have in it, that's 150% rate of return. 150% rate of return. Add the others to it, you're up at 255% rate of return, if I did the math correctly. 255% rate of return the first year that you own a single-family house. Now again, are you getting that rate of return? No. And if you're in the stock market, gold, silver, crypto, you're in a much more volatile market, an unstabilized market. There's all kinds of challenges going on with all those things. They are higher risk and lower rate of return, which makes no sense. Why would you go and invest in something that's higher risk and gives you a lower rate of return? But that's what the majority of you are doing. See, real estate gives you a higher rate of return and it's lower risk. Doesn't make any sense, because usually if things give you a higher rate of return, they're higher risk. Real estate is an anomaly. You get a higher rate of return and lower risk. And that's what you should be buying in 2026. Now, here's the good news. 2026 is going to be a buyer's market, at least the first 3 quarters. At least the first 3 quarters. Now is the time to strike. Now is the time to buy and start building your second stream of income. Start buying income-producing assets in 2026. And the good news is 2026 is going to be a buyer's market. You and I are the buyers. We're going to get the best deals. Now is the time to strike. All right. Hope that was helpful. This has been the Total Wealth Academy video podcast. Again, remember, we've got a radio show podcast as well. You can check both of those out at TotalWealthAcademy.com. If you're interested in learning how to do this, please come to our free sample class. There's a link below. Check out the free sample class and learn how to build a second stream of income. Learn how to invest in income-producing assets. That's the secret to 2026. All right. Thanks a lot for watching.